Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One thing that I want to emphasize on the straddle is that this is a strategy that I feel personally is misused in a lot of advertising from various educators in this business. And what I mean is that people say, oh, option trading is great. You can make money if the stock goes up. You can make money if the stock goes down. It's great. You don't have to pick a direction. Well, that's a half-truth. And I've said it in the past, I'll say it again, a half-truth, my pastor always told me that a half-truth is the same thing as a whole lie. So with that being said, let's kind of talk about the full story behind the straddle. You have enemies when you trade the straddle. What I mean is, let's say that you buy a call or you buy a stock. Well, then you're bullish. And as a bull, your enemy is the bear. I think that would make sense to everybody. Now let's say that you short a stock or buy a put. Well, in that case, you are bearish, and your enemy is the bulls. You don't want the market to go higher. When you do a straddle or a strangle, with which we'll discuss in a moment, you also have enemies. Your enemies aren't necessarily bulls or bears. It's movement versus non-movement. In this case, as you're going through this, your enemy is non-movement. So let's say, for example, that you buy this straddle. And this is an older example that we have up on the screen from December of last year. But on here you can see that we're buying 10 YUK December 2009 calls and 10 YUK December 2009 puts, both at the same strike price. Well, with that being the case, the overall risk on this trade is $5,610 plus the commissions. So with that, if the market were to expire right at 91.50 in expiration Friday in December, you would lose 100% of your money. You would lose the $5,610 plus the commissions. And once again, I don't know how likely it is to where it would expire exactly at that level, but that's what your ultimate risk is when trading a straddle. Now, what you're hoping happens on this straddle is several things, but the one thing that would really make your day is if this underlying either went up to 190 or down to 0. A lot of movement. Now, I'm using extreme, unrealistic examples, but I'm just trying to make a point with this, is that movement is a good thing when you're buying the straddle. However, by looking at the range of this, you need, assuming you hold this trade until expiration, look on the graph over on the right-hand side, you need to go beyond 85.89 to the downside or beyond 97.11 to the upside to make money on this trade. Those are the two break-even points with the straddle. If it stays within that range, you will lose money. You need a lot of money, a lot of movement to make this work. Now, the beauty of the straddle, it can go there's two ways of making money, but the downside of the straddle is the fact that you have such a wide range of loss potential when doing so. So there's upside and there's downside to the straddle. What's often not told is that wide range with which you have to move to start making money. Yeah, you can make money if the market goes up. You can see that on the risk-reward graph. You can make money if the market goes down. You can see that on the risk-reward graph as well. But your enemy is if the stock, or in this case YUK, the underlying for the yen, stays between 85.89 and 97.11. If that's the case, then this is a losing trade. So I'm all for the straddle and the strangle and everything with which we'll discuss today, but I think you need to have a good, firm understanding of the risk that's actually involved when doing this style of trade. Now, I want you to take a look at this and notice how our risk on this trade is $5,600. Let's say that maybe that's a little bit too rich for your blood and you don't like the idea of taking on all that premium risk. Well, the next alternative as to what you can do would be a strangle. Now, within the strangle, instead of buying an at-the-money call and at-the-money put, we're buying an out-of-the-money call and an out-of-the-money put. Same amount of contracts, 10 each, and we're hoping for the same amount of movement. Now, I want you to look at the risk-reward graph of both the straddle. You can see the V and the strangle. You can see the modified V, we'll say, on this. Within the strangle, similar concept. We're just using out-of-the-money options instead of at-the-money options. Now, the disadvantage to the strangle is that you're less likely to get a profit on such a trade. You have a wider range with which it needs to move for you to get to your break-even point. So, on this, the advantage, you don't pay as much money. In the previous slide, we're paying $5,610. On this slide, we're paying $2,910 plus the commissions. So with that, we don't pay near as much, but we have a wider potential of loss when doing such a thing. If this thing moves a lot, the straddle and the strangle can be your best friend. If it doesn't move at all, then you might have some problems when doing so on this specific style of a trade. Now let's get a little bit advanced on this, and like I said, we'll take questions on this as well. But let's turn the trades upside down. Now, typically, I'm not a huge fan of selling naked options on the currency options. I'm not against selling naked options, but it's something with which I've never sold naked options on the currencies. But the reason I'm bringing this up is that I kind of want to use this as a demonstration to show you how this would work. The opposite of the trade is a short straddle. The short straddle is the enemy of the long straddle. That's the opposing trade, so to speak. Now, a short straddle is when you'll sell a naked call at the money and sell a naked put at the money on the same underlying, at the same strike price, and the same expiration. Now, with that, what you're hoping now is that that thing stays the exact same. You do not want a lot of movement on the straddle. You want a lot of boredom. You hope that that currency never moves on this. Now with that, what I did was, in this example, is we used the same options, just flipped them upside down for the screenshot, and the market moved a little bit while I was doing it apparently, but the point is that you're getting about $5,000 in the actual income that's coming in. Now that's income, it's yours to keep no matter what. Stock goes up, stock goes down, currency goes up, currency goes down, but no matter what, the premium stays in your pocket. However, you're selling obligations. You're selling the obligation to be long at 91.50 and to be short at 91.50. So as you're doing that, you're selling the obligations, and this is cash settled, but your risk is from 91.50 and above and 91.50 and below. The ideal amount, the ideal price with which you will need to get that full amount of income is 91.50. Not very likely. However, you can look at the range when doing this on the screen. You can see that that it can go all the way out to 86.47 and 95.53 before you start losing any money on this trade. You have a range with which the market can stay into, and you'll still make some money on it. So, non-movement is the enemy of the long straddle, just like we were talking about earlier. In the long straddle, if that stock stays between those two levels, you lose money. You need a lot of movement. In the short straddle, you need that thing to stay within that range in order to make money. And once again, this is under the assumption that we're holding this until expiration. So, with that, these are strategies with which you can do when you have kind of a neutral bias against a specific currency, and maybe doing it in the stock market isn't right for you because you have other positions or you just have other mental biases with which you don't want to mess around with.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.